Right, feeling ready to maybe dip your toes into the stock market, but kind of feeling lost. We've all been there. Today, we're diving into how to invest in stocks with little money or experience
Ooh, nice.
from the penny hoarder. We're going to make it your personal cheat sheet for smart investing.
You know, what I find really cool about this article is how it takes all the mystery out of the whole process. I mean, investing can feel kind of scary, especially when you're just starting out,
Yeah, for sure.
but this piece breaks everything down, like in a way that makes sense and like doesn't make you want to run
It's
away.
very encouraging.
Right.
And the first myth it busts right away is this whole idea that you need a ton of money to even get started.
Yeah, totally. It really focuses on, building that wealth slowly over time, being consistent, making smart choices, not about trying to get rich quick.
Right. No crazy schemes here.
No, not at all.
Okay, so we don't need a pile of cash to start,
Yeah.
but how do we actually pick what to invest in? Like, how do we choose? Well, the article gives us three main options, especially if you're a beginner. Individual stocks, mutual funds, and ETFs.
Okay, let's start with individual stocks. This is where you're actually buying a piece of a company, like, say, Apple or Tesla. You could get huge returns, but it's also riskier.
So, like, you're putting all your eggs in one basket, right?
Yeah,
What if something happens to that one company?
exactly. That's why this thing called diversification is so important. The article warns about, like, getting caught up in the headlines and making, like, these quick decisions based on hype.
Oh, yeah.
And then selling everything when you, like, freak out.
Buying high, selling low.
The worst.
Oof, yeah. Not a good strategy.
Yeah.
So if individual stocks are like a little too spicy for a newbie, what are our other choices?
Well, mutual funds are a really good way to spread that risk out, to diversify. They're like these
Right.
pre-made baskets of different stocks, and they're managed by, professionals.
Yeah.
So you're basically pooling your money with other people who want to invest and buy a whole bunch of different stocks together.
So instead of just one company, you're kind of spreading your bet across like maybe a whole industry or even more.
Right, exactly. And there are two main flavors of mutual funds: index funds and then actively managed funds. Index funds just kind of follow a specific market index, like the S&P 500. They're passively managed, so that means lower fees, which is always nice.
Less money out of your pocket.
Exactly.
So if the S&P 500 like goes up 10%, your index fund would do kind of the same thing.
Yeah, pretty much. Now, actively managed funds, those are different. You've got this portfolio manager, a real person who is actively buying and selling stocks, trying to beat the market, always doing research on companies and making big decisions.
Sounds a lot more hands-on,
For sure.
but probably more fees too, right? To pay that manager.
Yeah, you got it. Higher fees because you're paying for their expertise.
So it's more risk, but also more potential reward.
Yeah.
So is it like worth it?
It really depends. Like, how much risk are you comfortable with? What are your goals? They could do better than the market, but there's also a chance they could do worse. It's a trade-off.
Definitely. Now, what about ETFs? Those seem to be like super popular lately.
ETFs, so that's exchange-traded funds. They're similar to mutual funds in that they help you diversify, but most of them are passively managed, usually tracking an index, which means lower fees, hooray,
Yeah.
and they're traded throughout the whole day, like individual stocks. So that gives you more flexibility.
Oh, I see. So you get the diversification of a mutual fund, but you're not stuck with those higher fees and you can like jump in and out more easily.
Exactly.
This article actually recommends ETFs specifically for beginners, right?
Yeah, they're a great place to start. Low cost, easy to use, built-in diversification. It's like the all-in-one package.
So let's talk practicalities. Where can someone who's maybe working with a limited budget actually begin? Where do we start investing?
Well, the article gets into some really great specifics here.
Okay.
It starts with 401k. Lots of people have access to these through their work.
Right.
And if your employer offers any kind of matching contribution, you got to take advantage of that.
Take that free money.
Literally free money.
It's a guaranteed return on your investment before you even start.
Right.
The article even talks about like actively managing your 401k, choosing the right investments within that plan, right?
Yeah, and that's where it's important to know, like, how much risk you're comfortable with. How long do you have until you retire? Are you decades away and fine with taking bigger risks? Or are you close to retirement and want things to be more stable?
Oh, so like if you're younger, you might put more of your 401k into, I don't know, stocks or something.
Yeah.
But when you get closer to retirement, you might move it into something safer, like bonds.
Yeah, exactly. And that's where this thing called asset allocation comes in.
Okay.
It's all about finding that perfect balance between stocks, bonds, real estate, all that stuff to create a mix that works for you, your risk level, your goals.
The article also mentions this thing about rebalancing your portfolio. What is that exactly? I've heard that before.
So basically, rebalancing means adjusting that mix over time
Okay.
because some investments might do really well while others don't, right? And so your initial balance can kind of get out of whack. Rebalancing brings it back to that like target allocation. So you're not too heavily invested in just one thing.
So if your stocks are doing great, you might want to sell some and then put some of that money into bonds,
Yeah.
kind of even things out.
Exactly. Helps manage the risk and keeps everything on track for your long-term goals. Now, apart from 401k, the article gets into ETFs, which is a whole other fun world.
There are so many of those, though. How do you even know where to start?
I know it's overwhelming.
Yeah.
But you got to begin by figuring out your investment goals. Like, are you just looking for a little piece of everything?
Oh.
Or are you interested in specific things like tech companies or healthcare or green energy or whatever?
So if you're like really into renewable energy, you could find an EPF that tracks those companies specifically.
Exactly. There are ETFs for almost anything you can think of. And don't forget about international stuff, too.
Right, because the article mentions investing in other countries can be another good way to spread your risk.
For sure. It's like, don't put all your eggs in one country basket. Emerging markets, those can have huge potential, but also come with bigger risks. Developed markets tend to be more stable, you know?
So you could have some U.S. ETFs, some international ones, maybe even some bond ETFs for good measure.
Exactly. You got it. And the best part about ETFs is you can get all that diversification in one little easy-to-manage package.
It's so much simpler. The article then dives into some practical tips for picking individual stocks,
Yeah.
which is pretty tempting, especially if you want to be more involved.
Oh, for sure.
But it sounds like picking individual stocks requires like a lot of research and a long-term mindset.
Definitely. You can't just jump on the latest meme stock bandwagon.
Yeah.
Or follow the hype. You got to do your homework, understand how the company actually works, and be prepared to hold on to those investments even when the market's doing crazy stuff.
That sounds hard.
It can be. The article mentions this idea called fundamental analysis, which is basically evaluating a company's financial health, their management team, their competition, all that stuff.
So you're not just looking at the stock price, you're looking at like the guts of the company.
You got it. Understanding the why behind the price, not just reacting to like what happened today. And speaking of the why, the article takes this really cool turn and talks about making sure your investments match your personal goals.
I like that.
It's not just throwing money at the stock market blindly.
Yeah.
It's having a vision for what you want to achieve with that money.
What are you trying to do with your life, right?
Exactly.
Yeah.
Are you saving for retirement? Maybe a down payment on a house? Your dream trip around the world?
I like that one.
Once you figure out your why, it makes choosing investments way easier. It keeps you focused on the long game.
Yeah, for sure.
Yeah.
It also helps you decide how much risk you're willing to take, right?
Totally. If you're investing for a short-term goal, you probably don't want to be messing around with the stock market's ups and downs. But if
Yeah.
it's for retirement, like decades away, then you can ride those waves.
Okay, so that brings us back to this idea of long-term investing, which the article seems really big on.
Yeah.
Why is that so important?
Well, because the stock market, it's like a roller coaster. It goes up, it goes down. That's just how it works. But over a long period, historically, it generally goes up.
So instead of trying to time the market, which is like impossible even for the pros,
Yeah, basis.
you just kind of got to ride it out.
That's the idea. Be patient, ride the waves, and trust that in the long run, things will go up.
Patience is key.
Absolutely. And that's where being disciplined really helps as an investor. But before we get into even more tips, I want to know, like, what really stood out to you so far? What parts were like, oh, yeah, that makes sense?
Honestly, what I liked was how the article didn't just talk about the how of investing, but also the mental side of it. You know, not freaking out and making rash decisions based on headlines.
Oh, yeah, that's huge.
Avoiding those emotional choices and just sticking to the plan. That seems crucial for, like, long-term success.
You know, totally. It's about being patient, doing your research, not just jumping in head first, and building that confidence over time.
Exactly. And I also loved how it emphasized that investing doesn't have to be this like crazy complicated thing that only experts can understand. There are options for everyone.
For sure, for sure. It's about taking control of your money and making those smart choices that fit your own goals, not someone else's.
So should we dig a little deeper into some of those practical strategies, like how to really maximize your 401k or how to pick the right ETFs?
Yeah, let's do it.
And this article even talks about like specific types of orders you can place when you're buying or selling stocks.
That's where things get interesting. So let's dive back in.
Okay, so we've gotten the basics down. We know we need to start small, be consistent, and we kind of get the different types of investments. But this article doesn't stop there.
Yeah.
It actually goes into like really maximizing your 401k,
Oh, yeah.
which is super useful for anyone working, a regular job.
It's like the best place to start, especially if your company matches your contributions.
Got to get that free money.
Free money, yes.
Right.
Don't leave it on the table. But the article goes even further than just like contributing. It talks about actually managing your 401k,
Okay.
choosing the right investments inside of that plan.
Okay.
And that's where it's all about knowing how much risk you can handle and like how long until you retire. Are you like decades away and comfortable with maybe a little more risk?
Mm-hmm.
Or are you getting close to retirement and wanting things to be, more chill?
Right. So if you're younger, you might put more of your 401k into, I don't know, stocks or something. But when you get closer to retirement, you shift it into something safer, like bonds.
Exactly. You got it. And that's where this thing called asset allocation comes in, which sounds complicated, but it's not really.
Yeah.
It's about finding that sweet spot between stocks, bonds, real estate, all that jazz, to build a mix that fits you, your risk level, your goals.
I see. The article also talks about this idea of like rebalancing your portfolio. What is that exactly?
So rebalancing is basically like adjusting that mix we were just talking about. Because over time, some investments might do really well, while others, not so much, right? So rebalancing brings it back to that target allocation, so you're not like too heavily invested in one thing.
Okay, so it's like if your stocks are suddenly doing amazing, you might sell some and put some of that money into bonds to kind of even things out.
Exactly. It helps manage risk, keeps your portfolio on track for those long-term goals. So beyond 401k, the article gets into ETFs,
Okay.
which are a whole other ballgame.
There are so many, though. How do you even begin to choose?
I know, right? It can feel kind of overwhelming. But you got to start with like figuring out your investment goals. What are you hoping to achieve? Are you just looking for a little bit of everything? Or are you more into like specific sectors, like technology or healthcare or something?
So if you're like super passionate about renewable energy, you could find an ETF that specifically tracks those companies.
Yes,
Right.
exactly. There are ETFs for pretty much any niche you can think of. And don't forget about international stuff, too.
Right, because the article mentions investing in other countries can be another good way to like spread the risk.
Like, don't put all your eggs in one country basket, right?
Right.
Emerging markets, those have huge potential but can be super risky. Developed markets are generally more stable.
So you could have like a mix of US ETFs, some international ones,
Yep.
maybe throw in some bond ETFs just to be safe.
Exactly. And the cool thing about ETFs is that you get all that diversification in one little package.
Love it. So the article also dives into tips for picking individual stocks.
Yeah.
Which, I mean, can be tempting if you want to be more hands-on.
Oh, yeah, for sure.
But it sounds like picking individual stocks takes like a ton of research and a really long-term mindset.
You got to do your homework. You can't just jump on the latest like meme stock bandwagon or follow the hype. You got to understand how the company actually works and be okay with holding on to those investments even when the market's being crazy.
So no panicking when things go down.
Yeah.
The article mentions this thing called fundamental analysis.
Yeah.
What is that?
Basically, it's looking at the company's financial health, their management team, their competition, all that stuff, like really deep diving into the company.
So you're not just looking at the stock price, you're looking at the whole picture.
You got it. It's about understanding the why behind that price, not just reacting to what happened that day. And speaking of why, the article does something really cool. It talks about making sure your investments match up with your personal goals.
I like that. It's not just, throwing darts at a board.
Exactly. You got to have a vision for what you're trying to do with this money. What's the bigger picture?
What are you trying to accomplish in life?
Are you saving for retirement? A down payment on a house? Maybe your dream trip?
Ooh, a trip. That's a good one.
Once you figure out your why, choosing investments becomes way easier. Helps you stay focused.
For sure. And it also helps you figure out, like, how much risk you're willing to take.
Yeah, totally. If you're investing for something short term, you probably don't want to be messing around with the stock market's ups and downs. But if it's for retirement, like decades away, you can ride those waves.
Okay, so that brings us back to this whole idea of long-term investing, which the article is all, like, really into.
It is.
Why is that so important?
Because the stock market, it's like a roller coaster. Ups, downs, that's how it works. But over the long term, historically, it generally goes up.
So instead of trying to be, like, super smart and time the market, which is, like,
Basically, yeah.
You just got to be patient and ride it out.
You got it. Be patient, ride the waves, and trust that over time, things will go up.
Patience is key.
Absolutely. And that's where being disciplined really helps. So before we get into more tips, I want to know, what really clicked with you? What parts were like, oh, that makes sense?
Honestly, I liked how the article didn't just talk about the mechanics of investing, but also the mental side of it.
Right.
Like not freaking out and selling everything when you see a scary headline,
Yeah, yeah.
resisting those emotional urges and just sticking to the plan. That
What?
seems huge for long-term success.
Totally. It's about doing your research, not just blindly following the hype and building that confidence over time.
Exactly. And I also loved how the article made it clear that investing isn't this super complicated thing that only like Wall Street people understand. There are options for everyone.
It's about taking charge of your money, making choices that work for you and your goals, not what some guru is telling you to do.
Okay, so should we get into some more of those practical strategies, like how to really get the most out of your 401k, how to pick the right ETFs?
Let's
This article even talks about like different types of orders you can place when you're actually buying and selling stocks, which sounds kind of complicated.
It can be, but it's super useful if you want to get more into the active trading side of things.
Okay, let's break it down. Starting with like the simplest type of order, the market order.
So a market order is basically like saying, buy this stock right now at the best price available. It's the fastest and easiest way to trade, but you might not get the exact price you were hoping for, especially if that stock is all over the place.
Oh, so if the price is like jumping up and down a market order, could mean you end up paying more than you wanted to.
Yeah, potentially. That's where limit orders come in handy.
Okay, tell me more about those.
So with a limit order, you set a specific price you're willing to pay, and the order only goes through if the stock hits that price or lower.
So it's like setting a limit, like a ceiling, so you don't overpay.
Exactly. Gives you more control, but the thing is, the order might not actually happen if the stock never reaches that price you set.
Interesting. So it's like a trade-off between like speed and price control.
Yeah, you got it. And that's why knowing about the different order types can really help you fine-tune your strategy.
This article also mentioned something called stop orders. What are those all about?
Stop orders are like safety nets for your investments. They're designed to automatically trigger a buy or sell order when a stock reaches a certain price.
So you're basically setting up like a safety net in case a stock starts tanking, or like to lock in profits if a stock goes way up.
Exactly. Powerful tools for both buying and selling adds a whole new level of strategy to your trading.
This is so useful, but it also makes me realize like how much there is to learn about this whole investing thing.
It's a lot, yeah. But the key is to just take it one step at a time. You don't have to know everything right away. Start small, experiment a little, and keep learning as you go.
And remember, you don't have to do it alone. There are so many resources out there, books, articles, online courses, even financial advisors if you need that extra help.
And don't forget, this article is a fantastic starting point. It gives you a really solid foundation.
Totally. It explains things in a way that makes sense, breaks down those complex ideas, and most importantly, empowers you to take charge of your own money.
Speaking of taking charge, let's talk about some common mistakes beginners make. Knowing what to avoid can make a huge difference.
Okay, let's do it. What are some of those big pitfalls to watch out for? All right, so we've covered strategies, resources, even like the psychology of investing. But what about those common mistakes, the ones beginners often make? This article doesn't hold back. It gets real about the things people mess up so we can all learn from them.
Yeah, and it's important to remember that these mistakes, they're not about being stupid or anything.
Right?
It's often about getting caught up in emotions, especially when you're new to this whole investing thing.
Yeah, for sure. Like the article talks about FOMO, that fear of missing out.
Oh yeah, big time.
You see some stock going crazy and you're like, I got to get in on that.
And that's where those headlines can be so dangerous. Remember what we said about chasing hype.
Yeah.
You end up buying high and then freaking out and selling low when things inevitably dip.
Not a good look.
Yeah.
So instead of letting our emotions run wild, the article really emphasizes having a plan,
Yeah.
like an actual roadmap to help you stay grounded when the market's going bonkers.
Exactly. It's about knowing why you're investing in something, not just because everyone else is talking about it on social media or whatever. This is where those clear goals we talked about really come in handy.
Right. Those goals are like your anchor. They remind you what you're working towards, even when things get bumpy. The article also mentions diversification, Or rather, the lack of it as another big mistake.
Classic beginner trap. You fall in love with a company or a sector, and you put all your money there,
Hmm.
forgetting to spread that risk around.
So even if you've done your research, you believe in this company, it's still important to diversify across different industries, different types of investments, even different parts of the world.
You don't want to put all your eggs in one basket, right? A well-diversified portfolio can help soften the blow if one of your investments doesn't do so well.
Makes sense. The article also warns about overtrading,
Oh, yeah.
which I can see being tempting when you're like eager to see results.
Totally. It goes back to that whole emotional thing. You get impatient, start trading all the time, trying to time the market perfectly, but that's almost impossible, even for pros.
Right. So instead of constantly buying and selling, reacting to every little wiggle in the market, the article says to chill out and take a longer-term approach.
Let those investments grow over time, ride out the dips. Trust that overall the market tends to go up. Time is your friend.
It's a marathon, not a sprint. Right?
Exactly. The article also talks about staying informed, but not getting totally overwhelmed by information overload.
Oh, yeah, there's so much out there.
It can be paralyzing.
Totally. So how do we avoid that?
You got to find those reliable sources, focus on understanding the fundamentals, and tune out the noise. Don't get sucked into like every little news story or opinion piece.
So it's not about like obsessively checking stock prices every 5 seconds.
No.
It's about understanding the bigger picture, those long-term trends, the things that really drive a company's value.
That's the stuff that matters. And remember, learning never stops. Don't be afraid to ask questions, get advice, and keep expanding your knowledge.
This whole article is like a masterclass in that. It takes something super complex, like investing, and makes it understandable, accessible, and even kind of fun.
Right. Who knew investing could be fun?
So we've explored different investment types, practical strategies, those common mistakes, even the mental side of it all.
Yeah, we covered a lot. But remember, this is just the beginning. The world of investing is huge, and it's constantly changing. So stay curious, keep learning, never stop exploring.
Couldn't have said it better myself. So to wrap things up, what are some key takeaways for our listeners? What should they walk away with today?
Well, first off, investing doesn't have to be scary. There are resources and options out there for everyone, no matter how much money you have or how much you know.
All right, start small, stay consistent, keep learning, and don't forget about diversification.
Oh yeah, spread that risk around. Don't put all your eggs in one basket. Build that portfolio that fits your goals and how much risk you're comfortable with.
Exactly. And last but not least, remember patience and discipline. Investing is a long game, so stay focused on the bigger picture and don't get rattled by those short-term ups and downs.
Ride those waves. Time is on your side.
Couldn't have said it better myself. So, until next time, happy investing. And don't forget to join us for our next deep dive, where we'll be tackling the crazy world of cryptocurrency. Buckle up, it's going to be a wild ride.
Oh yeah.